Hello. Today I'm very excited to be talking to you about risk management and especially hedging. Hedging is very important. It's one of the most important tools we can have in our quiver of arrows to protect your hard-earned assets. The market does not just go straight up and straight down, but goes up and down, and many times when the market is heading down, rather than holding on to your portfolio, the best thing to do is to hedge that against the loss. Now, there's a lot of various hedging techniques that are taught out there. I happen to believe that I've got the easiest, most simple way to hedge your portfolio that you can do when you see the time is right. My name is Dale Brethauer. I've been a trader for 35 plus years, hedge fund manager. I've been a guest speaker at 6 different platforms. I've written 3 financial books, and I am the founder of my educational website, www.optionsinfinity.com. I'm not one that can't do, so I teach. I have done for many years, and now I am working with mentees to help them to understand and be a success in this very difficult arena, trying to make consistent profits in the stock market. Now, this is a chart of the SPY, Standard & Poor's 500, for the last 2 years, going all the way back to March of 2018, all the way up to the current market today. And I think this is a very timely subject because the market is fueled by fear and greed, and there's been an extreme fear worldwide that has affected the market with the coronavirus, and you can see how it has toppled the market. Wouldn't it have been great to hedge your portfolio right up here and not lose that amount of money when the market went down? If you look at this chart over 2 years, you can see that there are 8 periods, just about 4 a year, and that's about the average when a hedge is to your advantage. You can see this one back here, and you can see it had a little bit of a drop, looked like about a 5% drop. This one here was about a 10% drop. This was very close to a 10% drop here. About 5% here, about 5% here, about 5% here, about 13% here. And that's usually what happens. This is a bull market. We're in a bull market, but you're still going to get corrections from time to time, and these corrections can be as much as 10, 15%. You want to protect yourself against that. Now, the market's been very strong lately, and you can see that it was starting to top out here a little bit. And any bad news will bring fear into the marketplace, and that's exactly where we're at right now. Okay. If you take a look at this chart, you say, okay, how did you know that this was a time to hedge. Okay, the first tool that I use is called the regression channel. The regression line, which you see in purple, is plotted by taking 50% of the price above and 50% of the price below. It's a very nice trend line. Then the green line is plus or minus 1 standard deviation, and the gold line is plus or minus 2 standard deviations. Now, applying that to the chart, now it starts looking like I can make some sense out of when I should hedge. When it comes up and starts touching this green line, that's a good time to be thinking, well, maybe a hedge is going to be in order. Or when it's way above and starts to have a topping action, you can also think about hedging there, hedging here, here, okay? It gives you more information as far as where the market is, and it might be starting to roll over a little bit and have a correction. Now, I'm just talking about corrections in a bull market. When we get into a bear market, and we will be getting into a bear market at some point in time, this technique is perfect for hedging your portfolio, keeping it at the level you have it, and then when things finally turn around, then you're back in with the amount of money you had in your portfolio before the bears started to roar. Let me just talk a little bit more about the regression channel, because this is a very powerful tool. I learned this a long time ago. I used to plot this by hand. Nowadays, I use Thinkorswim. I'm not affiliated with them, but they can give you a regression channel on any time frame. I happen to like it on the daily, but the 2 year, the 1 year, the 6 month is all going to be about the same here. And that gives you an idea of when something is overbought. The beauty of the regression channel is that the plus or minus 1 standard deviation, statistically, 68.2% of all prices are contained within that boundary. Then when you go to the -2 and +2, 95.4% of all price is contained within the plus or minus 2 standard deviation. That's the power of this channel. Occasionally you get outliers, okay? But most times, if you follow this on a regular basis, you'll become very familiar with when the market is starting to become a little bit overbought. And that's the time to watch for a hedge. Knowing that 68% of all prices are contained within here, that's a large majority. And you can see when it gets up around here that it starts to top. It's starting to top. Okay. Now, the other tool I use, and let me show you where I've got this chart. This is what I'm doing now is I'm going to focus right in on this period. And I think you'll probably all remember this. This was in December of 2018. Remember, a lot of people were talking about, will this ever stop? Is this the beginning of the bear? And no, it wasn't. Interest rates were still low. Unemployment was still low. This was a correction. And if you hedged and got back in at the proper time, you could have protected your hard-earned assets. And that's what we want to do. Now, this is a blow up of that period of time. And what I'm going to do is I'm going to look at here we were in December. We started to fall actually back here in October. October usually historically is kind of a weak month. But one of the things I love to do is follow the 5 and the 8-day exponential moving average line. I know that a lot of the large institutions follow the 5-day. And you can look at this and see how it will trade down and just follow that 5-day very closely, going both down and up. What I have found is when the 5 crosses below the 8, see how the green is down below the 8? The 8 is the gold, the green is the 5-day. When it crosses down below the 8, it's time to put on a hedge. And what I'm going to do is I'm going to show you later on this portion, when it crossed over, if you would have hedged, how you would have actually made a little money on that 10% drop. The rules are very simple. I like to keep things simple, because if you're going to repeat it and you're going to use this as a tool and you might not use it for a couple months, you want to have a tool that is so simple you can just execute it without a lot of thought. And that is when the SPY, the Standard & Poor's 500, is overbought, according to the regression channel, okay, kind of get ready to look to hedge. And then when the 5-day crosses below the 8-day, what you want to do is execute a hedge. And that's to simply buy the number of at-the-money puts to hedge your shares. And what you want to do is you want to buy those at-the-money puts about a month from expiration. And I'm going to talk to you in a second about how do you determine how many you want to buy. It's called a protective put. And you're going to hold on to that protective put until you see the 5-day cross back over the 8-day. Let's go back to this chart and take a look at it. Here's where I want to hedge. The 5 days going below the 8. I want to hold on to it. I want to hold on to it. I want to hold on to that protective put until right here. Now I can get rid of it. I have hedged. This was about 3 weeks of trading. When I put my hedge on, I have no anxiety, sleep good at night, because I know my portfolio is basically in neutral, and I let the market do its thing. And when it's done doing its thing, that's when I jump back in. Okay, how many puts should I buy? All right, what you want to do is you want to calculate how many shares are in your portfolio, your 401k, your IRA account, whatever. And you want to take those shares and divide them by 100. And that is the number of SPY puts at the money you want to purchase. And most times they're going to be right around $4, $5 a contract. or since there's 100 shares in the contract, about $400 or $500 for one contract. Let me give you a couple examples. Let's say you have a portfolio that only has shares of Apple stock in it, and you've got 2,000 shares. Well, to hedge those 2,000 shares of Apple stock, what you want to do is when it looks like when the 5 is crossing below the 8, you want to hedge with 20 at the money SPY puts. You divide the 2,000 by 100, you're going to come up with 20 at the money SPY puts. This is a sizable portfolio, okay? Let's say you have $100,000 in your IRA with the average stock price about $250. That's about 400 shares. So you would hedge with 4 at the money SPY puts. So you have a little homework. You have to decide, how many shares you're going to hedge. You have to figure out how many you need for the portfolio size you have. And then you're ready. You're ready when the 5 crosses below the 8 to go ahead and go into the market, buy your puts, protect yourself, and hedge your portfolio. You say, well, what happens if the portfolio goes up or the market goes up rather than continuing to go down? Well, that's fine. That's fine because the 5 is going to cross up above the 8. You're going to get out, and basically you will have made money on your portfolio more than what you would have lost on your put. Okay. So the way I have the hedging structured, it is a win-win relationship. So let's just take an example here and let's go back to that time in December 2018 when the 5-day exponential moving average line crossed below the 8. And I wanted to buy X number of at the money puts about 1 month out. On that day, the SPY was worth about $274. Well, let's say we're just making this easy for our calculations. You can put any number in here that's your portfolio. You don't. This is just an example, and it's an easy example so that everybody can follow that. I'm saying that all your portfolio is SPY shares. The shares were at $274. So you had 365 shares of SPY. Now on December 4th, you want to buy, in this case, I want to buy 4. I'm going to round it up. I'm going to buy 4 contracts of the 2 January 280 puts. And for that, I'm going to spend $5.24 or $524 per contract times 4. It's $2,000 and $2,096 if it expires worthless, or 2.1% for to insure your portfolio. It's cheap insurance, and we're never going to let it go to expiration. Never going to let it do that because if it goes up and the 5 crosses over the 8, we're going to be out. We're going to be out. Okay. Now, one thing I wanted to mention is when we did buy that on December 4th, the delta of this put option was 0.52, or in other words, for every dollar that SPY moves, that option will only move 52 cents. And as the market drops, that delta will increase, so you get more and more protection. But early on, if it reverts back and it goes up, you've only got protection that's only worth half of what your portfolio is. So that's the win if it goes up, and you win if it goes down because you protect. Okay. Held on to this until December 26th, when the 5 crossed back over the 8 to the upside. At that point, we sold the 2 January 280 puts for $33.81. And the delta at that point was 1. You can see how the delta had increased from 52 cents on a dollar to $1 for dollar. 33.81 minus the 524 times 100 times 4, we made $11,428 profit on the put. Well, in the meantime, the shares had dropped from 274 to 247. So the portfolio was down to 90,155. But I made this amount of money on the puts, the protective puts. Add those two together, and I actually had a 1% gain during that 10% drop in the market. It was a 10% drop in the market. It went, your portfolio went from 100,000 down to 90,000, but we made 11,000 in the puts. How did we do that? How do we do that? Well, I usually like to round up. So if we would have had a 1-to-1, we would have gotten 3.6 contracts, and you can't do that. So I rounded up to 4. So I'm getting a little more coverage than, and then it went to the delta of 0.1. So I made a little bit more than just breaking even, which was fantastic. And if you remember the drop, that 10% drop, that was a very tough period of time. People were wondering about that. And if you're going to be a success in the marketplace, you have to have very low anxiety. You have to have your ego checked at the door. You want to keep your emotions out of it. And that's what hedging will do. One other example. This is our coronavirus example. Let's say we had a $100,000 portfolio on February 21st, 2020, when the market started free falling. And the 5-day exponential moving average line did cross below the 8. The market at that point in time, the SPY, was worth $333, so it's about 300 shares. So this is a case where I want to actually get exactly 3 20 March puts, about a month out. And for that, we paid $5.37, and the delta was, a little bit less than half. Here we're spending a little bit less, and we only spent 1.6% for that insurance. Remember, we're never gonna let it expire. Now, I still have that hedge on. However, today, which is Friday, the 28th of February, if I sold today, that 20 March put would be worth $43.50. $43.50 minus my original purchase price times 100 times 3 is $11,439 profit on the puts. Originally, I had 300 shares at 333. It has dropped to 290, 43 points on the SPY. So your original $100,000 portfolio is now only worth $87,000. But I get to add the profits in from the put, and here's what my portfolio looks like. 98,439, or a 1.5 loss compared to a 13,000 loss or a 13% loss. This hedging takes all the anxiety out. It's a wonderful tool. It's a simple tool. It's something that you can do even if your timing is totally wrong and you think it's going to cross below the 8, the 5 is going to cross below the 8, and then it turns right around. Just take it off. Just take it off. Remember, you're not going to, it's a win-win situation. You don't have to worry about anything. I hope everybody enjoyed this video. If you do, what I'd like you to invite you to do is go to www.optionsinfinity.com, and let's go there right now. And let me see. Here we are. This is our home page. What I want you to do is scroll on down. We do a lot of vertical credit spreads, which I believe is the very best way to earn a consistent monthly income in addition to a larger portfolio of stocks. Not everybody has a large portfolio of stocks, and that's why we kind of focus on this to try to build up your account. But if you go here to our website, you can click on this button right here and learn about our 3 principal method of trading. If you read all that and you want to, explore me further on YouTube, that's great. If you want to become a member, it is $99 a month reoccurring. For that, you basically get position list and text and email alerts when I'm making a trade. When I see a good trade, I will text and email that to all my members. Every month we get together, every week we get together, and I teach a class, and it's plenty of time for questions, and we go over all our trades, and that's once a week on Tuesday afternoon. If you can't make it, we have it always recorded and posted on the website. Then we have every Thursday and Sunday, I come in and kind of review our positions and what I see of the market. And then we've got plenty of other education on the website as a member that you can definitely take advantage of. I hope everybody enjoyed this. I hope you can use it. And I look forward to having you as a member. Bye-bye now.